Joining us now to continue the conversation around the August CPI print, we've got Jennifer Lee, BMO Capital Markets senior economist, and Eric Wallerstein, who is the Yardeni Research chief market strategist. Great to have you both here with us. I mean, I'm sitting here taking a look at the CME FedWatch probability here, and even though we're waiting for a little bit of an update here to perhaps factor in exactly what we saw come through CPI, it still looks like there's handedly this probability that leans more towards a 25 basis point cut. And Jennifer, in your notes to us, you say that's the big question, whether or not it's going to be 25 or 50. Does this report solidify that the Fed can feel comfortable with a 25 basis point cut?
First of all, good morning, and thank you for having me on. And I would say totally solidifies a 25 basis point cut. I don't think we were ever really in the 50 basis point camp. Even after last week's jobs reports, I don't think that it wasn't so broad-based weak that it would, I think, push for a 50 basis point cut. So I think this report, this would be the fifth decent report in a row for the Fed, giving them the comfort and the confidence to cut again or to start cutting. And I think 25 basis points is a good place to start.
Eric, what do you think? Do you agree?
Yeah, I think 50 basis points also was not in the cards, nor is that really a thing the Fed would do absent recessionary conditions or a financial crisis emerging. And for everyone who's asking for a 50 basis point cut, I think they should really reconsider the amount of volatility that would cause in short-term funding markets. It's just not something the Fed wants to risk. And even the biggest doves have signaled, it's a labor market that's cooling. We're going to go a quarter point and then go from there.
Eric, do you see a 50 basis point cut before the end of the year after the election?
No, I think you, again, need a crisis or a recession, which we definitely don't foresee. So I think if anything, and we'll see in the summary of economic projections, if anything, they go a quarter point at each meeting.
Jennifer, as I'm taking a look through some of the indexes here within the CPI, of course, shelter is the one that catches the attention naturally. I mean, at this juncture, is there anything additional that you expect the Fed to be able to enact, the levers that they are able to pull in order to start attacking some of the biggest components that are contributing to this continued rise in the all items index, which is notably shelter right now?
Right. So, I mean, there's only so much that monetary policy can do. It's a very blunt instrument, as we know. Some of the other factors, contributing to, I mean, it's basically like, low inventories still, off the lows, of course, but low inventories of housing available still. And there's, that has been an issue for some time, with land availability, labor availability as well. So that's, that's one of the sectors, by the way, that we're still seeing a shortage is on the construction side of things. And that's hampering, I think, the ability to build, and that's also pushing, the rent prices or housing prices higher. So that's something, again, that the Fed cannot do directly. But overall, just dampening demand will at some point, that's what's taking effect right now. This is what's causing the economic slowdown or what's contributing to the economic slowdown.
Eric, maybe to no surprise, we are seeing futures under a bit of pressure here following the hotter than expected core reading on that month over month basis. When we talk about the odds maybe increasing slightly here for the Fed then to go 25 basis points next week, what do you think the likely equity reaction is going to be?
Yeah, I mean, I think 25 basis points, it'll definitely depend on what the SEP and then, what Powell says at the press conference. I think if they went 50, equity markets would fall and bond markets would rise. I think it would signal the economy is heading in the wrong direction. We're behind the curve. And then it would, kind of unleash the volatility that we saw with some of the carry trade unwind as Japanese rates and US rates come closer together. So I think 25 basis points is probably priced in. It's always fun to say things are just always priced in, but I don't think that should, wrangle the equity markets too much.
And what kind of moves thereafter do you believe the markets are trying to price in as well and get some early inclination? Or is that something that we have to wait until the 17th and the 18th after the FOMC meeting, Eric, to really get a sense of where the markets can continue to price in what the pathway might look like?
Yeah, I mean, I think the path looks pretty extreme right now based on market pricing. A terminal rate that's around 2.8%. I don't think the Fed is going to get there. And especially how quickly the market thinks the Fed is going to cut rates below 3% just in the next 12 months. I think that's overzealous. I think the market's been doing that this entire cycle. They priced in 7 rate cuts at the beginning of this year, and now we're arguing about the first one with only a few meetings left to go. So I think those expectations will come off. But I don't think that's a huge worry for stocks. I think if those rate cuts get priced out because growth is stronger than expected and GDP comes in strong for the third quarter and the labor market indicators aren't too bad and we keep seeing consumer spending, then stocks will have more room to run as earnings continue to grow. So I don't think it's a huge deal if the Fed doesn't cut that much. I hope they don't, because that would probably mean we're in a recession. But yeah, the pricing is pretty extreme.
Jennifer, what's your assessment just on the economy's footing at this point, right? We have seen a weakening labor market. That has been a concern, especially to some on the street. But you pair that with the fact that inflation does seem to be under control. The Fed doesn't seem to be panicked at all at this point. Are you confident that we are going to see a soft landing?
So we are, that we're still very much in that camp. And I have to say, I completely agree with Eric. I mean, I think a 50 basis point cut would reek of panic. And it's almost like, we're totally behind the curve at this point. So it makes sense. We saw an upward revision to Q2 GDP of 3%. Of course, that's a look in the rearview mirror, but still, the latest numbers that we saw for personal spending for July was still pretty decent. And there's across the board spending increases overall still. So, it's still looking at a soft landing. Things are slowing. We're tapping on the brakes, and that's completely as expected after 525 basis points of rate hikes. This is completely the fact that the U.S. economy has held up all this time just speaks to the resilience of it all, I think. But I think soft landing is still very much in the cards. But of course, everything is going to be data dependent.
How might tapping of the brakes translate through to the employment situation and the broader labor market as you're tracking it, Jennifer?
I mean, we're still seeing job gains, which is a good thing. I mean, the first thing, right before the number came out, I remember saying, as long as we're going to see a plus sign, that's a good thing. But as long as we're seeing job gains overall, and over 100,000, almost 115,000 was decent in historical terms, but obviously not compared to what we've seen lately. And the jobless rate of just over 4% is still very low in historical terms. So again, we're still seeing that gentle rise, I guess you want to say, for the jobless rate, slowing in job growth, but there is still labor demand out there, and especially in certain pockets. So I think that would translate into the overall narrative of a soft landing.
All right, Jennifer Lee, BMO Capital Markets senior economist, and Eric Wallerstein, Yardeni Research chief market strategist. Thanks to you both for joining us here this morning.